live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Wednesday morning, middle of the week. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's been a spectacular Monday. It's been a terrific Tuesday. Well, I think we're looking for objectives for a Wednesday. I'm Prashant, with me, my colleagues Mangalam and Nigel. Guys, hi, morning.
Good morning. How about a worldwide Wednesday where the market goes up and then dips are being bought into as they were yesterday?
Sorry, what was it?
Worldwide.
Worldwide.
I think it's working Wednesday, guys.
Working Wednesday, well, that is
Some of the
what
kids
it
have it off.
always is.
But yeah, I mean, these markets have been absolutely on fire. You have to participate on the upside. And I think it's getting to that time when maybe in the near term you could get a couple of percentage points pullback. But you're investing for the next decade, right?
Yeah.
This belongs to India. And if you're buying it for a longer duration, well, in all probability, the odds are stacked in your favor.
I mean, a percentage points also in a market so strong looks, quite a bit. Maybe a day, 2 days, I don't know. Well, that's the kind of market we're in where downsides are, they'll happen. They're markets. These are cycles and inevitably it'll happen. Nothing goes up in a straight line. But for now, things have been very, very good. So let's just quickly tell you what you need to know as we begin this Wednesday. Strong momentum continued yesterday. The Nifty, of course, went up 400 points on Friday. On Monday, that is the start of the week, yesterday, it went up half of that, almost half of that. So pretty good. We ended above the medium-term resistance level. I don't want to call it resistance, but the level of 20,850. So 2 days, 2,700 done, 2,850 done. What next is the question. I'll come back to levels in a bit. Cues from global markets are mixed, but they're better than what we had when we started same time yesterday. And yesterday turned out to be the way it is, which is the fact that the markets completely overlooked the weak cues from US. So data suggested in the US that labor markets are finally softening a little bit, right? You had the Nasdaq, which ended up about 1/3%, the Russell, which was down about 1.37%. Actually, exactly opposite of what we saw day before yesterday. The Russell actually was up, the Nasdaq was under pressure, and it was the reverse last night. The 10-year yield lost 8 basis points. The dollar index is back near 104 kind of levels. So neither here nor there, no real kind of one decisive thread going through markets which kind of drove price action, no big disappointment or surprise. I think that's the kind of phase we're in the US as well. Markets have done very well. The S&P, for example, has reached consensus year-end sell-side targets of about 4,600. So, there also, there is... I think people are now wondering what next as we head into 2024. Let's just circle back to levels here. And what does all of this mean? So sustaining above 20,850 is important. If we do that, we open up levels to about 21,100. 2850 and 21,100 we put out exactly same time yesterday as well. This is the next resistance zone that we put out. The lower end is done. And now we look at 21,100, which is the upper end. This is nothing but Fibonacci retracement extension levels based off the fact that we broke above the previous highs. The daily RSI, the relative strength index, one of the simplest ways to gauge whether the market is getting a little overheated, is telling you that it is getting a little overheated. So that's at 84 levels. That is clearly in the overbought zone at this point in time. But there is no real sign. You got to have, overstretched and overbought markets can remain overbought for a while. Unless you get specific signs. But right now, there are no real signs of a reversals yet on the indices, so as to speak. Having said that, I would say expect a pullback at some point, which could last a day or two. That's about it, whenever that happens. Then I would expect the market to kind of pick up and move up again. Because, the bias has been on the upside, and that I think remains absolutely strong. If anything, that urge has become even stronger. Support comes in for the Nifty at about 2578 and 2382. If you get declines, that 1 day or 2 day kind of declines, these are supports you could use. These are nothing but the 20 and the 40 hourly moving averages, exponential moving averages on the Nifty. The very, very near-term kind of levels on the way down. The Bank Nifty, it's headed to its medium-term resistance, which is 47,700. It's about 700 points away from where we left off yesterday. Daily RSI, similarly on the Bank Nifty, is now around 80, which is a little better than the Nifty, but it's still in overbought zone. So again, I think you will get maybe at some point a day of pullback, a day or two of pullback on the way down. If you get that, 46,484 to 46,653 are near-term support levels where the market should find some supports coming in. The GIFT Nifty will come up on your screen. Let's take a quick look at what that is indicating to us. On your screen. So GIFT Nifty is indicating that we'll start basically at the upper end of that range, which was 21,100. But will that be really the case? Yesterday, the market opened flat, but almost immediately the market started to move higher. We'll see if that is the case for the third day in a row. It's going to be quite spectacular if we get a third day like what we've had over the last two. Guys.
Well, since we're an all-boys party, I'm going to use this, right? Remember, guys, when we were in college and you were wooing that one little girl that, you set your heart on, and all through the year she said no.
I don't know what you're talking about.
I'm not interested in you. But for Christmas, she says...
What are you talking about?
I have no idea. I didn't speak to girls in college. We were studying. Okay, sorry. Go ahead.
I don't think, Mangalam, you would want me to get to that. But let me go ahead with my story for now.
Go on.
So let's go ahead. And in December, she decides, wait, I'm going to go to prom dance with you. That's what the FIs have done, right? They've been jittery all through the year. And suddenly, come December, they're showing us the big money. The FIs, well, they're buying for the 8th straight session. And they were initially net short on the index. Now they're almost net long. So in futures as well, things have turned around a fair bit. The Nifty Bank, that's the one that holds the key. That plays out weekly expiry today. And that's going to be the driving force from here on from a bullish perspective. Looking at the advanced decline ratio, well, stocks, they could do their own thing. We'll see a couple of big outperformers as well. But maybe you get a sense that the mid-cap index could be in for some few days of consolidation, though individual stocks will do a thing of their own. Yesterday, you had way more number of stocks that were declining in comparison to the number of stocks that were advancing. What did the FIs do yesterday? Well, they added long positions, close to around 17,000 contracts, and they covered some shorts as well, which takes the long position to around 49%. But the next plate that I'm going to pull up is going to tell you the story of the last 45 days. The FIs were net short, and we were at around 18,800. Just take a look at that. Gradually, you did see that the short positions did come down. Now they're down to only around 4,000 contracts. And that's why I just take a look at the Nifty. The Nifty has moved close to around 2,000 points. The short positions are down by close to around 1.45 lakh contracts. So that's the kind of short covering that we've seen. Yesterday, you had a few strikes that were active, 20,800, 20,700 put. Both of them were fairly active in trade. And there was a sense that there was writing at those levels. On the upside, though, the 21,000 call, well, there was some bit of activity out there, which brings us to the levels. Now, on the downside, you're looking at yesterday's low. We bounced off the 20,711. Well, that could be a bit of a support going by yesterday's data. So that's one data point. The other factor, the 20,700 put was seeing some addition. Premium was roughly around 30 rupees. So 20,670, that becomes a support as well. 20,670, 20,711, that's your support zone. While on the upside, you have resistance at around the 21,035 odd. I think that initially could face some bit of resistance, and we'll take it from there. But the Nifty Bank, that's the one that's breaking away. It was running into resistance at around that 50 as well as the 100 DMA. If you pull up that chart, you'll see the Nifty Bank, well, it was facing resistance out there, and then it's just broken away from the 50 and the 100 DMA, and that's a perfect chart that I'm looking at. The big question from here is, can the Nifty Bank go ahead and conquer 50,000? You'll say that's a tall ask after such a big rally. How do we see 50,000 on the Nifty Bank? I'll tell you what, if you pull up year to date, the Nifty Bank is underperforming the Nifty by close to around 500 basis points or thereabouts, because the Nifty Bank is up 10%, the Nifty is up 15%. If the Nifty Bank can do as good as the Nifty, maybe want to do a 15% odd, then we're going to be moving towards the 50,000 odd mark. So the Nifty Bank holds the key from here. How much more does it have in terms of flows, in terms of short covering, in terms of valuation support? Well, that's the driving force. It starts off in the green, and I think you need to maintain your long bias.
One needs to maintain the long bias. The question, Nigel, is that how many got into this long? And the question is that a lot of people would be asking that, can we actually buy, when the market opens about 100 points higher after it's seen the kind of rally that it has? That'll be an interesting one to watch out for, because now, apart from just the flows and fundamentals towards the end of the year, is the fear of missing out that may play out too. And that's something that played out yesterday perfectly too. We opened flat. From there, we went higher in, yesterday's trading session on both the Nifty as well as the Nifty Bank. So both the intraday charts for the Nifty and the Nifty Bank come up for you. You see a bit of a dip intraday that there was, just about 100 points from the highs. And from there, the move was even more powerful. So what's happening in the market right now is that the dips are getting shallower and the up moves are getting stronger as well. So would it make sense to buy a shallow dip? or would it make sense to buy that 100-point uptick that we're seeing is something that we will keep an eye out on most definitely. The FIs have gotten positive in our markets, buying for the 9th consecutive session. And what's interesting is that, incrementally the numbers have increased. November 30th is a one-off because we had the MSCI flows, etc. as well. But over the last few trading sessions, if you look at it, yesterday 5,200 crores was the highest that we've seen ex of exceptionals itself. And in Nifty futures, where we're seeing a bunch of, FII money being put in index futures for the Nifty Bank, that is increasing as well from 500 crores to around closer to 700 crores on a daily basis. If that increases further, we will see the Nifty Bank outperform as well. The FII is, like you said, now 49% long in index futures. US macros looking not too bad either. 4.2%, the yields below that for the first time since September. We're not only talking about risk-free, we're talking about risky assets as well. Bitcoin, that itself has sneakily crossed beyond $44,000. In fact, it's the highest level that we've seen all the way since April 2022 itself. When we're talking about gains, it's 165% higher in 2023 so far. And crude is slipping continuously. We are seeing Brent at around $77, which is close to a 5-month low. So that's a positive for India as well. Your point on mid-cap index, the question is, what happens to the quality of stocks in the mid-cap index as well when fear of missing out takes over? Yesterday, there were 373 stocks on the BSE, which hit a fresh 52-week high. And we had only 27 stocks which hit a 52-week low. And of those 27, none of them belong to the A group. Yeah. And of the 373 that moved, nearly 200 belong to the A and B group itself. So good quality stocks are moving 52-week high. But, when we aren't seeing a lot of selling out there, that's something we'll be watching out for too. The RBI policy meet starts today, and the street has practically priced in a pause for both the Indian Reserve Bank as well as the US FOMC after the data that came by. So those are a bunch of things that we'll be watching out for.
I think both you all gentlemen don't want to remember the college sweetheart for a more pleasant evening at home, but at least we can say the FIs are back in love with our markets. I think both of you all will be on board on that.
The FIs are back in love with our markets. The important part, however, is not just the college romance. It's about the long-term game. And for the long term, I think
brownie points.
Investors are doing
it out of the park.
The FIs keep coming, going.
You'll have a pleasant evening.
I think Sonal will join us in about 5-6 minutes, right? And so we'll ask her. Let's just quickly tell you some views which we are getting from our experts that we want to put out. So Chetan Sheth of Nomura says that they expect modest positive returns for Asia ex-Japan stocks in 2024, supported by strong earnings growth rate, stabilization and valuations, a softer US dollar and a better fund flow environment. However, they do not expect smooth sailing ahead. Unlike consensus expectations, according to Nomura, the key sources of uncertainties stems from US inflation growth policy outlook. China's growth issues and policy outlook and political cycles in Asia are the other risks that they see developing.
All right, let's also get you some money market views. Kunal Sudhani of Shinhan Bank says the US dollar strengthened despite lower US Treasury yields and mixed data. He says traders continue to reinforce their view that the Fed has finished its tightening cycle. He says eyes now will remain on the US ADP, employment change and non-farm payroll data, for further cues from a US dollar perspective. For the USD INR, Kunal says that 83.25 acts as a strong support, whereas on the way down, we will have 83.50 would be resistance.
Well, on bonds, Neeraj Gambhir of Axis Bank says that bond yields declined due to lower US Treasury yields and crude oil prices at the start of the week. However, he adds that higher SDL supply and tight system liquidity during the week led to upward pressure on the yields. He expects the 10-year benchmark bond yield to trade in that range of 7.2 to 7.3% this week as the market awaits the outcome of the MPC meet.
Right, and let's get stock specific. Then we have a bunch of them to track, and we'll do it in just a bit in our special top 10 segment. But we're looking at Bank of India, India Grid Trust, Power Grid, Himadri, Specialty Chemicals, Oberoi Realty, NRB Bearings, and Shriram Properties on the back of positive news flow. Green Panel Industries, Sapphire Foods, and Honasa Consumer are the stocks on our radar that are likely to open in the red.
All right, well, let's welcome in Arvind Sanger, who's with us, Managing Partner at Geosphere Capital Management. Arvind, good morning. Good to have you with us here. Thank you very much for joining us. How much more do you think, Arvind, after, the weekend election results, and of course, I mean, the global stuff, which we've already spoken about the last time you were on, but I think that got reinforced expectations of the peak rates in the US were reinforced by Fed Chair Powell last Friday. So it's a pretty positive, constructive kind of environment. The end of the year, it's seasonally a strong a time for stocks globally. Is this likely to extend? And of course, the market here in India has been the strongest.
Well, I mean, it's been a great year for a lot of markets. The U.S. NASDAQ is up almost 37-38%. Obviously, the Indian market has been one of the best performing markets in the world once you get past the U.S. And I think the fundamentals for India, if the U.S. headwind from an FII standpoint of the headwind of higher rates is now behind us, and it's a question of, how quickly and how long does that take for the Fed to turn the other side, then that, removes one big reason for FIs not to be investing in India or other emerging markets. So that's another positive. But I think the growth story and with this election, it's clear the political outlook for 2024 is for very much continuity, which investors like and are makes it more comfortable. And I think the Indian growth story remains pretty intact, and therefore I don't see an obvious line in the ointment. But as you were talking earlier, things look extremely overbought short term. So purely from a very short term tactical standpoint, I'm not sure what will happen. We never know what will happen, but there will be something that causes some profit taking, some pullback. So to the extent that investors are, in the short-term trading mindset, then it's careful not to get too euphoric and to be patient on pullbacks. But in terms of the long-term investors like ourselves, we don't see anything in India that is a fly in the ointment. I still remain cautious about U.S. whether or not we're going to have the Goldilocks, no recession, or whether we will have a recession. I must admit that I've been wrong in thinking that a recession was imminent, but it's not a done deal yet. But any mild recession does not affect India too much. So therefore, the India story looks very solid.
Hi, Arvind. Good morning. Good to see you in. Arvind, what about your approach? If you're going to have continuity at the center, that'll be good news for particularly public sector companies, because some of them have turned around and have turned around in style. You were early on the couple of those names. I recall you telling us about the power demand and how you're playing that theme. You stay invested, or do you think at some point of time you'll start trimming those positions?
No, I think the public sector's theme is not. The power sector theme is something we like.
Yes.
Obviously, a lot of the large plays in that, whether it's an NTPC or it's a Coal India or it's an NHPC line the public sector. So yes, that's one area to play. But I think the domestic stories in terms of demand in various areas, whether it's engineering companies or it's companies that are in consumer goods, or it's companies that are in the domestic healthcare. I know a lot of people think of Indian pharma industry as being outward facing. We find inward facing companies. Whether it is in regularizing the drug sales in terms of organized retail in pharmaceuticals, or it is in domestic healthcare. We think that's another theme that is going to be very powerful in the coming years. So there's a lot of themes that are still early that are there, and power remains an area that looks very intriguing.
All right. The pharmaceutical domestic healthcare theme is something that you like over and above the power sector that you just spoke about. Arvind, thank you for joining in. A quick chat, but insightful nevertheless. What we'll do is take a short break. On the other side, we'll get you all the stocks which are lined up for you.
ICL.
Welcome back. You're watching us here on Bazaar Morning Call. It's a blockbuster opening that the Gift Nifty is indicating after what has been a blockbuster week as well. But let's drill it down to individual stocks. Our research team is standing by with the CNBC-TV18 list of top stocks for the day. That's our entire team. Let's start with the financials and a couple of others as well. Abhishek, you have Bank of India and India Grid on your radar.
Well, CNBC-TV18 News Break has been confirmed. So Bank of India has launched its QIP. The total size is about 4,500 crore, which comprises of 2,250 crore of base issue and upsize option of another 2,250 crore. So the indicative price is around rupees 100.2 per share, which is at a discount of 5% to SEBI floor price and around 9% discount to the closing price of yesterday. Calculation shows that if BOI raises 4,500 crores successfully, Tier 1 ratio can increase by 119 basis points. Book value declines by 2.5%. Net worth increases by 8.2%, and that is on account of equity dilution, which could be around the 11% levels. So Government of India stake can decline by 8% if they successfully raise this money. India Grid sources say that India Grid QIP has been launched. Total issue size is about 550 crore, of which 350 crore is the base issue and 200 crore is the upsize option. Indicative price is around 127 per share. The discount is very small, 2% to the SEBI floor price and 1.5% to NSE's closing price. The book running lead managers are Axis Cap, Ambit, HSBC and SBI Cap to this issue. Back to you.
Thanks a lot for that, Abhishek. Well, let's hop across to Vivek. He's here to tell us about Power Grid. Vivek?
Well, good morning. It's another interstate, power transmission project that the company has managed to be the successful bidder under. Now, remember, the bidding was done under the TBCB route, that is tariff-based competitive bidding. So, Power Grid emerged as the lowest bidder. This particular bid and this particular project is for a renewable energy park in Gujarat. So, some positive news flow coming for Power Grid, going with a green on this name.
Okay, all right. Vivek, thanks very much for that. That's Power Grid. Keep an eye. Stock did very well. I mean, actually, PSUs have been on fire for a while now. Sonal is now standing by with the list of stocks in focus. Sonal, morning.
Good morning, Prashant. I have 3 stocks on my radar. Let me start with Green Panel. One of their MDF manufacturing facility, it has been disrupted by cyclone that we are seeing in Chennai. Company is taking adequate steps to resume operations at the plant at the earliest, is what they say. Himadri Specialty Chemicals, there's an interesting foray that the company has made. They will be setting up manufacturing facility for lithium-ion battery component manufacturing. The total capacity here will be 2 lakh tons per annum, which is targeted here. The project cost of 4,800 crore rupees in phases over next 5 to 6 years, and this will be funded via a mix of internal accruals and balance from debt as well. Oberoi Realty, now remember, company had entered into an agreement with NRB Bearings back in May 2023 to buy 2 land parcels from the company. Now the said acquisition has been completed yesterday. They said they have paid the entire consideration of 196 crore rupees, and now the deed is in Oberoi Realty's name. So this is an update which is positive for the company.
All right, Sonal, thanks a lot for that. So those are a bunch of stocks that we should watch out for. And then we had a lot of block deals take place yesterday. Vivek joins in with a roundup of that. Vivek.
Absolutely. Quite a few interesting blocks happened, in yesterday's trading session. First, we'll go with Sapphire Foods. What's actually happened is that the promoter entity, that is Aringia, based out of Mauritius, sold 4.2% stake in yesterday's block deal. Out of the total 7.99% stake that they held in the company, Government of Singapore picked up over 3% stake in the block deal yesterday. The other stock on the radar is Honasa Consumer. What's actually happened is that Fireside Ventures, like we told you earlier, sold almost 1.9% out of the total 7.57% stake that they held in the company. Norges Bank picked up close to 1% over there. Shriram Properties, it will be viewed as a significant overhang being lifted. TPG sold the entire 9.86% stake in yesterday's block deal. We alerted this as well to you yesterday. Which are the top buyers? HRTI Private Limited, Tara Emerging Asia Liquid Fund, as well as BNP Paribas Arbitrage Fund were among the top buyers in yesterday's block.
All right, Vivek, thanks a lot for that. For Honasa, it's interesting because on December 2, the lock-in on 3.8% equity was opened, and then we have around 1.9% which has been traded already. Let's see what happens to the remaining 50% out there. With that, it's a quick recap of all our top stocks that we are tracking. Stocks with positive news flow are Bank of India, India Grid Trust, Power Grid, Himadri Specialty Chemicals, Oberoi Realty, NRB Bearings and Shriram Properties, while stocks on the opposite side, the negative news flow, have Green Panel Industries, Sapphire Foods and Honasa Consumer.
Okay, well, those are all the top stocks, but Sudarshan's been reading through various brokerage notes. He joins us to tell us all those stocks that he's tracking today. Sudarshan?
In the brokerage corner today, we have first Adani Ports. Kotak Institutional Equities has a buy call and target is rupees 1,060 per share. It says market share gains have been significant in FY24 so far, and it has increased volume and EBITDA estimates by 4% and 6% respectively. Citi has also written on the stock. It has a buy rating and target is raised to 1,213 from 972 per share. It says company continues to execute well and grow its dominance, and despite strong business and healthy balance sheet, valuations remain suppressed. It says despite the rally, stock has an ample scope for valuations to re-rate. Next one is Asian Paints. Macquarie has an outperform call and target is rupees 3,800 per share. It says company is focusing on budget end to outgrow market, and it reiterates double-digit volume growth expectation for H2 FY24. UBS has also written on Asian Paints. It has a buy rating and target is raised to 3,900 from 3,800 per share. It says higher working capital and initial losses may limit new entrants' potential aggression. It expects company to mitigate risk on margin via premiumization and backward integration. Last one is two-wheelers. CLSA downgrades stocks as it believes these stocks are fairly valued, led by sharp rally. It downgrades Bajaj Auto to underperform and target is rupees 6,382 per share. It downgrades Eicher to underperform and target is rupees 4,129 per share. It downgrades Hero Motor to outperform from buy and target is rupees 4,127 per share. It maintains sell on TVS Motor and target is rupees 1,378 per share. CLSA expects margin in electric two-wheelers to remain challenging.
Except TVS. So thanks very much for that. Except TVS, I think even though it's a downgrade from CLSA, the price targets are all, in some cases, comfortably above where the current market prices are in the case of. So it's in a way kind of catching up with where prices have run up to, but at the same time moderating their view, which is coming, Mangala.
Well, for Asian Paints, what's also benefiting them is the fact that crude is at a 5-month low. So that should do well for them. And we are in festive season quarter. The next quarter should look good for them as well. But for crude and all things commodities, we have Manisha Gupta joining in to give us a roundup. Manisha.
Thank you for that. Well, I'll start with crude itself, and at a 5-month lows, yes. And there are doubts on the OPEC cuts that they have put out in the meeting there. Also, there is an increase in production, not just from Libya, but a huge amount of inventory rise in U.S. Production in U.S. at all-time highs also seems to be weighing onto the prices there. If you look at the last 1 week itself, we have seen the crude oil prices decline by nearly 6%. What is also not helping is the fact that the dollar index is firm. The Chinese demand is uneven, and we also have had the Moody's cut China's outlook to negative. This is exactly the reason that you have seen pressure come in for the metal prices also. So if you look at copper, that one is trading at a 1-week lows. Zinc is trading at 1-month lows. Nickel has continued to underperform the sector, and today perhaps is the 13th day that we have seen the lead prices also continue to decline. It's not such a great move also in the precious metal prices, where gold and silver also have started Asia slightly on the negative.
All right, Manisha, thanks very much for that. We'll come back with more on commodities. We'll be joined by Deven Choksi after a quick commercial break. So we'll talk about specific stocks that he's got his eyes on. We also have the management of StoveKraft that they'll join us to discuss their business outlook during this festive period. Stay with us.
Stock market, huh?
Welcome back. Hope you're having a good morning. Well, we have overnight Qs in. We have already stated down all the top stocks that you need to look at. So let's get to some fundamental analysis as well. Deven Choksi, MD at DR Choksi, joins us on the show. Hi, Deven. Good morning. Well, need to ask you about the sector that's in focus. You have the banking names that have been doing very, very well. What's your view, particularly on HDFC Bank? And I ask you this because year to date, actually, the bank was one of the lone banks that was in the red, and that was dragging the banking index. Now that's on the verge of moving into the green and maintaining its 10-year record that every calendar year for the last 10, it's given positive returns. Your take.
Hey, good morning, Nigel.
Well, fundamentally, nothing wrong with the bank. Whatever you asked for, I think, is there in the balance sheet. You have a growth in the corporate lending book, which is close to around 20%. In the retail lending book, I think the growth is 20% and above. In housing finance, the loan growth is around 20% plus. And also the primary sector in which the bank operates. There also, I think, the growth remains in the double digit. So all in all put together, the bank's balance sheet and the portfolio, loan portfolio, remains quite balanced. It is not tilted either towards retail nor towards the corporate. So that gives you a good confidence, good satisfaction. On the other side, I think the major amount of challenge which the bank is facing, and I think that is a challenge for which the stock is underperforming, is about, I think, not having a strong digital front end. The customer acquisition process and loan processing activity, which is required to be done through the use of stronger digital front end called fintech, is missing in the entire piece. Should they build this particular piece faster? In my viewpoint, I think the bank could possibly move faster in expanding the loan book because of the size of the balance sheet that they have. There is no denial of the fact that I think the company is growing at around 20% plus rate of growth. So in next 4 years from now, the size of the book is expected to go in the range of 45 to 50 lakh crores, which could possibly place it among the largest in the world, probably among the largest in the world. So from that perspective, the stock remains underpriced on potential and the possibilities. The fintech is one missing pie. If it happens, then possibly the stock holds the potential to give you 20% plus kind of return in a shorter period of time.
All right, so that's your view on HDFC Bank. I wanted your thoughts on Reliance as well, Devin, largely because one, HDFC Bank was an underperformer, is now catching up. Reliance is still lower year to date. Nothing particularly wrong with the fundamentals, so to say, of the business as well. There is a fair amount of growth potential in their new businesses too. How long before Reliance starts to move too?
Yes, Mangalam. Good morning. Well, I guess I think the important point out here that the stock fundamentally remains absolutely strong and convincing, be it in the conventional businesses of refining and petrochemicals, or for that matter, higher amount of growth in the oil exploration business. I think the company remains absolutely on a solid wicket and continues to contribute, if not more, around 50-55% of the total EBITDA pie of the company's entire book. On the consumer side of the business, the retail and the geo platform business, they also end up contributing 45 to 50% of the entire EBITDA of the company. So all in all put together, I think nothing wrong with this particular business. On the contrary, consumer-facing businesses hold a larger amount of potential since they continue to grow at the rate of around 20%, which is a steady rate of growth on such a large balance sheet. I would think that 2 or 3 technical factors possibly are hurting this company. One, the domestic fund exposure possibly has reached to a peak level, as a result of which I think they are unable to add further into the portfolio for the exposure purpose. And that is possibly one of the reasons. And because of this reason, I guess I think the index funds which are operated by the FPIs, probably I think they find this stock worth shorting. And as a result of which, I think against the entire market rising, they also hold the short position. That's where Reliance comes in. In my viewpoint, I think once the renewable portfolio starts showing the commercial production, maybe in 24-25 financial year, we would see the larger amount of short covering led rally first taking place in this counter, and then possibly I think the appreciation. Fundamental remains strong, so I think we remain convinced on the fundamental side of the story. Market technicals could correct in a bit from now. So hopefully I think the things would probably settle down and the stock start giving you better return. Whatever it has not given in last 2-3 years, quite possible that in 6 to 8 months time, the stock has a tendency, it could produce more than I think what it has not produced in last 2-3 years. So one remains confident because of the strength of the fundamental at this point of time.
Okay, Devin, hi, morning. What about the Adani Group? You know, on Monday morning at 8 o'clock, we highlighted that the 2 spaces to watch is PSU banks after the election victory, and the other is Adani Group. I mean, stocks are up 40%, I mean, in some cases, in the last 2 sessions. This morning, Sudarshan was highlighting how a lot of brokerages, after I think a visit to the Mundra port, have revised their rating up on Adani Ports. But that's a well-owned institutional name. But I mean, it's catching up with a lot of other names as well. Green was locked up in 20%. I think there were 3 Adani names limit up 20% yesterday. What do you like there?
Yes, Prashant, good morning. Well, I think if you look at the entire portfolio of infrastructure, within that portfolio, Adani Group has, I think, completed almost all the portfolios as far as I think their ground level installation and the expansion is concerned. Hereafter, whatever the further growth is happening, be it in the power segment, be it in the solar power segment, be it in the growth segment, I think they are incremental growth. What I'm trying to say is, I think at 60,000 crore worth of EBITDA at the group level, they are growing this particular EBITDA book at the rate of around 20%. And that visibility is permanent. I think it looks, very clear that the growth is continuing at the rate of 20% on current capacities that they've built, be it in the area of port, roads, airports, or for that matter, the other infrastructure assets, including the railways, including the gas distribution. In my viewpoint, I think the company remains absolutely strong and convincing. Having capitalized the debt in last 6, 8, 9 months, I believe that I think they have corrected even the gap in the balance sheet as far as the leverage is concerned. And given the kind of current EBITDA, I guess I think the overall portfolio of debt, I think is comfortably met at around 2.5 times, I think, to the current EBITDA, which is not probably sounding any alarming. In my viewpoint, I think the stocks deserves re-rating. Of course, I think the speed at which they move, I think that definitely cannot be understood fully. But the fact remains that I think they would get re-rated, given the strength of higher cash generation that these portfolios are offering to investors.
Okay, all right, Deven, we appreciate you stopping by and giving us your view on a whole host of stocks. We're wishing you a good trading session ahead and look forward to having a chat with you in the coming days as well. Well, time to move on now. I had a chat with the investor, Monish Pobrai. He spoke on a range of issues, from his portfolio investment, India being a good investment as well, his relation with the late Charlie Munger, and why crypto space is not for him. Let's listen in to an excerpt of their exclusive conversation I had with him.
I think that, and I had a lot of discussions with Charlie on this in the last few years, is I have, in more than a quarter century of investing, I have the most bizarre portfolio one can imagine today. So about half the money, close to 40-50%, is invested in Turkey in 3 stocks. Another 25% or so is invested in the coal industry in the United States, and we have a little bit in India, and basically I think that I've never had this kind of a unusual concentration, but I also feel with what we own that basically don't need to do much for a while. So I find in general the US markets, which is where I spend the most time, to be either fully priced or overpriced. It's not a problem to identify great businesses in India. I find that it is a problem to find them at attractive valuations. I think the area that in India that might be very fertile might be small caps and mid caps, but one would really need to be in the country all the time and, poring over those, one business at a time and kicking the tires. So I don't see as much opportunity amongst the larger Indian businesses, but I do believe that India Inc. Will do extremely well. Long crypto, I'm not short crypto. I don't care what happens to crypto. It's really irrelevant, So my focus is on the businesses that I do have an interest in, that we do have money invested in, and so on. So there are lots and lots of areas of the market that I would be completely incompetent on, and that's perfectly fine.
Well, you can catch this very exciting conversation that I had with Monish Pobrai later today at 4:30 p.m.
Right then, sounds exciting. Candid chat on Charlie Munger and investments by Monish Pobrai. But let's talk about the first corporate interaction that we have lined up for you today on Bazaar. StoveKraft, that's the stock on our radar. The company is looking at expanding its reach via exclusive outlets, mostly in North India. They plan to open 5 exclusive stores in NCR in 1 month. Rajendra Gandhi, who's the MD at the company, joins us to discuss more on their business, but more importantly, how the festive season was for them as well. Mr. Gandhi, thank you so much for joining in. I remember speaking sometime about a month ago. You said the festive season has started on a decent note, but not a blockbuster note. If it were to continue that way, you would see around 11 to 12% growth in your revenues for the entire year. 1 month later, the festive season is behind us. Would you change your thoughts or would you maintain them?
Good morning. Yeah, as you mentioned, we have launched our first store in Delhi, and then we plan to roll out 5 stores in this month. And that's the beginning of our foray into the retail in the north. Regarding demand, I can continue to state that demand is good. It's pretty good. It's not very, very strong, but it is definitely better than what it used to be comparative to the last year's similar time quarter. That is the third quarter of last year. Of course, there was a festival period. Diwali was in the middle of this quarter. I can say Diwali was reasonably good, and the demand continues to be reasonably good. It's not on the very high demand side, but not to regret at all.
Okay, all right. So good enough, Mr. Gandhi, to see double-digit revenue growth?
Yeah, we are very confident of a double-digit growth if current scenario continues. But if there is a spike in demand in the forthcoming quarter, and if we can grow better, then we can see a good double-digit growth. But otherwise, we are confident of a double-digit growth.
So double-digit growth, gross margins will hold at around 35%. Are you confident about that? And what does it mean for EBITDA margins? Does it move into double digits comfortably, low teens?
So we have already crossed that 35%, and we are in the range of 36%. We believe we can be here and improve upon this. And overall, the business, the way it stacks is at a 36% gross margin. And if we are able to contain all our costs at 25%, that should leave us at 11% EBITDA. That's where we are working.
All right. Mr. Gandhi, hi. Good morning. Just wanted to understand this sort of physical stores and the one in Delhi is live, and what happens from here? But the question is, will margins improve because of this store strategy, physical store strategy? The reason I ask is offline, consumers are, I mean, they move around much faster, right? I mean, a lot of it is based on discounting, what is a better product, better offer, etc. With a physical store, we've seen this with other businesses as well. Margins actually, although investment, etc. is required, margins perhaps can improve on a sustained basis. Is that how you see it as well? If you can talk about that.
Yes, our gross margins for the retail remains between that 48 and 52%. Our revenues from our retail in the last 1 year are actually doubled from where we started. We are seeing very promising business proposition with our retail, apart from giving us a huge exposure to the brand. Of course, we fit perfectly there because for the consumer, it is a huge advantage that he is getting high quality products at the price points that are very attractive for them. We continue to invest on various new categories. We are continuously indigenizing several products, which we are offering that benefit to the customer. And I think retail is giving that wow factor for the customer. I mean, overall, for us, the retail, we believe, is one of the best channels that is going to be in the future, which is going to both aid margin, revenue, and brand growth.
All right. Apart from retail expansion and the festive season, etc., something that happened was there was an IT surge that happened between November 21st to November 23rd. That also disrupted some of your operations. Could you give us a sense of what exactly took place out there, and do you have any clarity on the outcome of that surge?
Yeah, as we have already disclosed, there was an IT surge at both of our manufacturing facilities. So manufacturing facilities were disrupted for the two days at our smaller facility, that is at Himachal, but for a longer period, for about 5-6 days in Bangalore. So it took a little longer time for them to take that huge inventory. Our Bangalore facility is quite large, and they would want to have the complete inventory verified. which in our opinion, we have cooperated with the authorities. And I think, of course, while the disruption is there, and they had the reasons to check, but I think everything went well.
Okay, very quickly, Mr. Gandhi, you said retail has doubled from the low base in the last year or so. Tell us what's the percentage as a percentage of your total revenues now, and where do you see that headed, say in the next 3 years or so?
No, so the base was very small last year.
Yes.
So if you go revenue growth, we will grow at least 10, 15 times or at least 10 times over the last year. So that is not a comparable growth because we had very few stores in the beginning.
Mr. Gandhi, as a percentage of your mix in the next 3 years, where does it go? Since it's very small, as a percentage of a mix, what do you see it go to?
We believe at least the retail will start contributing 15 to 20% in the next 3 years.
It's good speaking to you, Mr. Gandhi. Thanks so much for joining and giving us a sense in demand. You know, clearing out the air in terms of that rate that was there, and also telling us your vision with retail spiking up, contributing better to margins, as well as taking it to 15 to 20%. Time to slip into a short break, though. When you come back, we'll have our technical experts with us. Mitesh and Sudarshan will be joining in.
It is very
Welcome back. Well, the GIFT Nifty suggesting we're in for another good start. But how do you trade from there? To help us out with that, we have Mitesh as well as Sudarshan who joins us. Good morning, gentlemen. Mitesh, you go first. Markets have been trending up. Would you try to book some kind of profits? Would you think of booking some kind of profits right now at these levels? Because the kind of run that we have seen is phenomenal. Or do you think we're good for much more? Just trail your stop loss and maintain all your positions on the long side.
Morning, Najib. So I think the answer to this question lies in the objective with which you are trading. If you're trading with extreme short term, I think I would be tempted to book profits slightly aggressively, say 50-60% of the positions, purely because, as you were also mentioning, we are quite overbought on the hourly and the 2-hourly charts. Positionally, I think the market still looks good for more. But I think with today's gap up, I think people who are trading with a 2-3 day, 4 day kind of perspective with that kind of a short-term idea, it might be useful to take some profits off. And I think buying should now be done closer to about 20,650. Or in the worst case scenario, I think we might actually head towards 20,500, 550 in case that happens in the next couple of days. But I think I would look at dips to buy into aggressively. The two levels which I mentioned are the levels which I'm watching broadly as the immediate support areas. But any dip, I think you would explore at least if not in the index, in stocks which stocks you want to build up positions upon. I think this market on the short to medium term is very good, but on very immediate basis or 2-3 day kind of basis, I think we are quite overheated.
All right, a little overheated on a short term basis. Sudarshan, for someone who would not have had the opportunity to enter and participate in this up move, do you think the train is gone and maybe they should wait out before entering, or maybe nibble a little bit at every level from here?
Good morning. See, for anyone who's missed out all the 2,000 points, the fact still remains that we are in a strong uptrend and we are in a seasonally bullish period. So I do not think you should sit out or wait out. What you should do is to wait for minor dips and enter the market. Keep a 150 point stop loss from your entry level, not from any other point, because entries are different now for everyone, every trader. Keep a 150 point stop loss that gives you money management protection. Any minor dip intraday should be used to take long positions in the Nifty and the Bank Nifty.
All right, and individual stocks, what would you recommend, Sudarshan?
Well, Asian Paints is a buy. The stock has just moved up from a fairly bullish pattern. Buy with a stop under 3150. Bata India is giving a similar pattern as Asian Paints. Maybe FMCG is putting its act together, maybe. Buy with a stop under 1600. Dabur is also a buy, which is again coming to the same group. It's again a bullish pattern confirmed. Buy with a stop under 530. And Tata Chemicals is a buy. That's let's say a high risk buy. We are assuming that a bottom is in place. Buy with a stop under 960. Everything is for buying.
Mitesh, what about you? Individual trades?
I also have all buy calls today, much like last couple of days. ICICI Bank made a fresh high, so buy here with a stop at 990. Look for a target of 1060. Nestle is a buy with a stop at 24,400 for a target of 25,150, 25,200 thereabouts. Also buy on Grasim with a stop at 2055 and a target of 2110. And Coromandel is the final buy call, which I recommend buying with a stop at 1184 for targets of 1260.
Okay, you know what we'll do is, thanks very much for your trades, both Mitesh and Sudarshan. We'll take a quick commercial break here. And I want to just, talk about Honasa. Technically speaking, where is that looking? So Mitesh, coming back to you for that. We'll take a break. The pre-open session should be with us. And Harshvardhan Dole of IIFL will also be joining in to put the focus on, the boom that we're seeing in power stocks as well. Stay with us.
Powered by sensex.
Okay, welcome back. I think we are hitting the pre-open session just about now. I'll give you a sense of the moves. 60 points higher is, I think, where the pre-open is. The first indicated prices are starting to come through, coming up in just a bit. Honasa has lost about $100 from the top in about 5 sessions flat. Beg your pardon. Mitesh is with us still. Mitesh, Honasa, is it a sort of good level to look at it constructively or not yet?
Prashant, I think one problem which I have is that the chart history is very limited. I think, the stock has barely been there for about 3-4 weeks. But I think the initial understanding is that the earlier consolidation phase of 325 should come into play, and that could be an area from where the stock could reverse. So there's still some more time to go. But again, as I said, this is very, very limited chart history. We have barely any, I think, 2 or 3 reference points. I think with that, the limited understanding is that around 325, if you see a reversal pattern, then maybe approach to buy into it. But it will not be giving any signals of a long-term uptrend because there's hardly any history to comprehend.
No, my bad. I mean, I should have 3-4 weeks of history, so not very much that you can do in terms of projecting anything, etc. Thanks very much, Mitesh. We'll come back to you for more. I think we have the F&O guest, Mangalam.
We do, and Rajesh Palvia joins in now. Rajesh, your thoughts on the indices, the positioning, and stocks?
Good morning. So overall structure is on the bullish side. Looking at the data setup, put writers are aggressive. They are shifting base on the higher side. The call writers are on the back foot. That clearly shows that this momentum can extend further for both the indices. Nifty is likely to hit 21,000, or we can cross 21,000 level also in this continuation of this uptrend. Looking at the data setup, we are initiating here to buy a call option of 20,900, which was closed at around 67 rupees, and we are projecting target of 140 to 150 for this call option. And on the downside, one can keep a stop loss of 35 rupees. For Bank Nifty, the important support now is placed at around 46,750. That level is very important on the downside. Until Bank Nifty not breaks below those level, trend is likely to remain on the buying side. Whatever small dips or volatility gives you opportunity around those level is a buying opportunity, or on the higher side, 47,500 to 47,600 are the next target for Bank Nifty. On the stocks front, Aditya Birla Fashion is looking very promising. Almost stock managed to be breakout of last 5-month consolidation range. There was a long built up in previous session. Looking at the structure, we believe that ABFRL can continue furthermore upside towards 255, 260 zone. So one can buy this stock with stop loss of 233. The second stock is from Power Space, that is Power Grid. Clear outperformance. Stock is enjoying all-time high trajectory. In the previous session, long built up was there. Stock is making series of higher top, higher bottom formation. So Power Grid is buy for upside target of 235, 240 with stop loss of 216. And the third stock is from Pharma Space, that is Sun Pharma. Again, stock is enjoying all-time high trajectory. Stock is holding its previous breakout level. So looking at the overall structure in Sun Pharma, we expect we can see a momentum in today's session towards 1275 to 1280. So one can buy this stock with stop loss of 1215.
All right, Rajesh, thank you for joining in. You spoke about Power Grid. We will shortly discuss the power space with Harshvardhan Dole as well. But before we do that, just a quick word on Asian Paints. There have been a couple of brokerage notes this morning. Also, with crude prices being about at a 5-month low, we have seen some bit of improvement in prospects for all these companies which use crude as a raw material. So we've got a note from Macquarie where they say that the management meet takeaways that they had with the company shows that the budget end is doing good, and they do reiterate the double-digit volume growth in the second half of this year itself. And then there was a note coming in from UBS as well, where they've upped their target price from 3,800 to around 3,900, where they believe that the competition, which was likely to come by in the fourth quarter of this year, may not be as aggressive, largely because of higher working capital and initial losses. And the company will mitigate the risk on margins via premiumization and the backward integration capex that they've announced as well. The stock around 3250 odd rupees, but the target price largely is between 3,800 and 3,900.
Thanks a lot for that, Mangalam. Well, let's hop across to Abhishek. He's here to fill us in on the Momentumizer stock in our Momentumizer segment. Abhishek?
Well, Nigel, HDFC Bank is on my radar with respect to Momentumizer. The stock has outperformed Nifty in last 1 week and last 1 month, and the stock has outperformed Bank Nifty in last 1 month. So on a weekly basis, HDFC Bank is up 6% when compared to 4.85% gain that you are seeing on Nifty. However, it's underperformed Bank Nifty, which is up 7.14%. On a monthly basis, HDFC Bank is up 8.6% when compared to 7.4% gain that you are seeing on Nifty and about 7.8% gain that you are seeing on Bank Nifty. Yesterday, the volume was on the higher side in last 3 trading sessions, and the delivery volume was around 58%. In terms of technical level, the stock is currently trading at 1,624 per share, which is higher than its 200 DMA as well as 20 DMA, but below the 52-week high levels. Back to you.
All right. Well, as they say, the elephant is starting to dance. HDFC Bank with momentum finally starting to come back into that one. Abhishek, thanks very much for that. Let's focus on the power space. Jefferies hosted the India Power Summit. Vivek is joining in with the key takeaways from that gathering. Vivek, over to you.
Well, absolutely. They hosted quite a few important stakeholders at that particular Power Summit. And here are a few of the key takeaways. And we'll also tell you, what NTPC as well as, the stock that's under quite a bit of scrutiny at this point of time, IEX had to say at this particular summit. Number one, the broad consensus, in the summit was the fact that power shortages are expected to continue at least for the next 18 to 24 months. Along with that, power demand currently is being led both by the industrial space as well as households. Power generation as well as, transmission and distribution investments, they expect will rise 2.2 times to almost $280 billion in the time period between FY24 to FY30, and this is when you're comparing it to FY17 to FY23. So significant capex is what is being envisaged. Now coming to NTPC, they've also spoken about the very strong demand. They're saying that they are on track to achieve 15 to 20 gigawatt of renewable energy capacity by FY25, and along with that, the key point to focus on as far as NTPC is concerned is the monetization of the renewable energy arm. Now coming to IEX, the major overhang continues to remain whether or not India will adopt market coupling. So number one, they've actually spoken about power demand, and they're saying the short-term power demand is up almost 13 to 15% of the total generation versus just 9%, a decade ago. What, SN Goel, has said is that MBED implementation is quite tough, given the fact that it has a lot of implementation challenges. So market coupling implementation without MBED is something at this point of time they believe is not quite feasible, and this continues to remain a key trigger to watch out for as far as IEX is concerned.
All right, Vivek, thanks a lot for that. We will take this discussion shortly forward with Harshvardhan Dole as well. But before we do that, Sudarshan and Mitesh, let's get you back for the 9-10 calls. Sudarshan, what would you pick?
Consider buying Dabur with a stop under 530.
Mitesh?
ICICI Bank with a stop at 990 and a target of 1,060.
Okay, all right. Gentlemen, thanks very much for that. Harshvardhan Dole is with us. He's Senior Vice President, Institutional Equities at IIFL. Harsh, good morning. Great to have you with us here back in the program. And I guess it's a busy time for you, right? Because everything under your coverage is it's boom time. Well, the markets are doing well, but power, oil companies through the roof. Let's just start with power. So you heard Vivek highlighting some of the takeaways from that Jefferies summit. Just talk to us a little bit about how the mood is changing, what's happening, what investors are doing afresh. Are some of the non-believers turning into converts now? And where is maximum interest in the power space, in the value cycle?
Well, Prashant, thanks for having me. And you aptly said, I think the mood of the market seems to be in the energy space. And more so because of the favorable verdict that the elections have thrown up. So looks like the risk of a knee-jerk reaction in terms of populist measures seem to have dying away. But that said, I think if one assesses the basic fundamentals of the sector, the fundamentals of the sector are turning now more favorable for the industry and going away from the consumers. And the reason why I say this is the demand is fairly strong and the supply is coming in a much more calibrated manner. And I would actually, expect the demand side measures to remain fairly firm. And at the same time, government to be proactive and encourage the industry to increase the supply side. We have seen a great, call from the minister to step up thermal capacity by 80 gigawatt at a time when India is preparing to add 400 gigawatt of renewable energy. So I think the thrust is more on capacity additions. And typically we have seen that whenever there is investment in generation, it necessitates a concomitant investment in transmission as well as distribution. So the whole capex cycle, which was perhaps stuck for some time, is showing signs of revival, which is making almost every stakeholder quite exciting.
So what, according to you, is best placed right now from an investment standpoint? I mean, would you look at the generators? Would you look at the transmitters? Would you look at people who finance these power players? Would you look at renewable? How should one look at this space from an investment standpoint? How should one allocate funds?
Well, there is money to be made, in my opinion, in every segment of the sector. Be it somebody who's producing fuel, i.e. somebody like a Coal India, which will actually see meaningful uptake in the coal that they produce. There will also be an opportunity for somebody who's going to generate power because of the massive tailwinds available for them. Somebody who's going to distribute and transmit the power, there's equal opportunity. And at the same time, somebody who's going to offer solutions in the form of smart metering, financing them, there is ample on the table as well. So it's basically an opportunity over the next maybe 5 to 7 years as to pick and choose the revenue model that we like. Frankly, if you ask me...
Go ahead.
So frankly, if you ask me, the way we would like to prefer the theme is by owning some of the companies who have got solid balance sheets and revenue models which allow them to pass on any escalations in the input cost. One should be mindful that the macro is still uncertain. Interest rates are all over the place. Forex is all over the place. So we would like to own, some of these cost plus gencos and cost plus transmission companies.
You've told us what's on the buffet. Tell us what should we take on the plate.
So last week we put out a note saying that the valuations are no longer distressed. But if one were to do a reverse DCF, what the market seems to be pricing in is maybe a single-digit free cash flow growth for companies like NTPC, Torrent Power, CESC. And that's what we like. We like the revenue models a lot. Perhaps one can be a bit mindful in terms of entering into these stocks, but their broader revenue models are pretty much intact. And that's what we continue to like.
And I think last time we were on, you had mentioned before the rally in CESCs began or around just the time it was taking off, I think you had CESC as a pick. So it's not done very much for the last couple of years, but it's been good so far now. Got it. You still think there's money to be made in Coal India? I mean, after the 60% move this year?
I think there's money to be made, in my opinion, for two reasons. One is the volume they continue to surprise in terms of growth, and secondly, the pricing continues to be favorable, for which the free cash generation and the dividend yield is fairly attractive. So we continue to like Coal India as an asset class.
All right, Harsh, very quickly, we just got a few seconds before market opens, but what about OMCs? You have been positive. They've just taken off, rocket on those stocks out there. Have they overdone themselves, or is there more to be made?
Yes, I think from a valuation perspective, they're still cheap, but the momentum seems to be fairly strong. I think every dip, every correction in these stocks is a great entry point.
Wow, that's quite something. Thanks very much, Harsh. Good speaking with you, and it's a pleasure having you with us here on CNBC-TV18. Dips are a buying opportunity in OMCs. Stocks, P multiples are still single digit, and that's in a market where P multiples of 30, 40, etc. are quite regular out there. So just a couple of seconds to go for
30, 40 is value for FMCG. Don't talk about 30, 40. We're talking about the 80s, 90s. And
I was speaking to somebody yesterday. I was saying that it's all relative now, right?
Yeah.
I was saying, well, I'm going to buy FMCG stocks, not because I particularly have any great love for them. It's just that they've not moved for some time. Valuations are still high, but others have gone up quite a bit.
All right. Well, we're just a few seconds away from market opening, and 21,000 appears to be on the cards. We're just 45 points away from there. The market's opened up, gap up. The Nifty is holding at around the 20,950 odd mark. Stocks that are running away. Adani Enterprises and Adani Ports, both the top gainers. They were the top gainers yesterday. They're continuing with their good form. You have Power Grid as well. That's up close to around 1.5%. BPCL as well up 1.5%. And the Nifty Bank has opened up with a 200-point gain. Remember, that's the one that holds the key. If the Nifty needs to move up, then the Nifty Bank needs to get closer to around that 48, 49, 50,000 odd mark. The other stocks that are not doing too well this morning, well, you have Bajaj Auto, that's down close to under 1.5%. Some kind of profit taking is what you've seen after the recent run. Apollo Hospitals as well. Yesterday, some bit of negative news coming in there in terms of their operations, and maybe an inquiry being launched by the Delhi government as well. So that stock is down close to around 1.2%. And Eicher Motors has been running very, very hard. For this week itself, it's still up close to around 5%. And the last 1 month as well, it's seen a good recovery. That one's down close to 100%. But otherwise, a good start. The Nifty holding with 90-point gains. The mid-cap index, you have way more number of stocks advancing than declining. And the Nifty Bank raising its bat. It's a double century. Mangala.
It is a double century on the Nifty Bank. The Sensex a triple century. A century on the Nifty as we speak. 20,955. And, the lesser than expected opening as compared to the GIFT Nifty has swiftly been bought into. We opened with a gain of almost 30 odd points. Now we're sitting with a gain of 100 points. In the mid-cap end of things, 2,100 stocks are advancing, and this compares with just about 350 stocks which are in the red on the National Stock Exchange. And the biggest gainer actually is Tata Chem. It was one of Sudarshan's picks. It was a high-risk bet, and that is the top F&O gainer this morning. The other one is India Cements. That's doing well. AB Fashion and Retail too seems to have been coming out of its consolidation as per Rajesh. He had looked at it favorably from an F&O standpoint. That stock is gaining too. And then we have Ambuja Cements, which has been gaining along with the entire Adani pack. On the red side though, we have Torrent Power, which is down about 2 odd percent. TVS Motors seeing some profit booking, perhaps down about 1%. We have MCX and Balrampur Chini not doing too well as well, mildly in the red. But the red stocks are far and few, and the gainers are far outnumbering the ones which are losing. From the broader markets, stocks which are gaining with a fair amount of volumes, we have Adani Power, again the Adani Group stocks. Adani Wilmar continues its run higher, and DCW is the one that stands out with a gain of almost 8% in the first tick of trade itself.
Okay, well, it's 3 days in a row is just an outstanding move. We were up almost 100 points. We're up about 75, 20,900 plus comfortably and looking good. So, I just want to sort of begin by looking at run through the Adani Group names. Adani Green is up another 14%. It's doing the most within that group this morning. Yesterday it was up 20%. Adani Solutions, which is basically Adani Transmission, 8.5% after yesterday's 20% move. Adani Power, of course, Mangala mentioned, 6% higher. Adani Ports went up 14% yesterday. It's up about 3.5%. And Enterprises is up about 2% or so. So this is, another very, very strong start to the group, which is basically completely re-rated in the last couple of days or so. What else? I mean, TV18 Broadcast is up about 2.5%. Of course, the channel that you're watching is part of the group. You've got Sterling and Wilson Solar, which is moved up another 5%. So, from about 300 to almost 400 in about 6-7 trading sessions now. You got Reliance Infrastructure, which is up about 2.5%. Iron Exchange is up 2%. So Tata Chemicals we mentioned, but GHCL, which is the pure soda ash company, that's about 5% higher as well. So that's what's coming through right now. CAMS is down 3. Suzlon is down about 2.5%. And I think Bajaj and Eicher are some others which are lower. Canterville had a pretty large move over the last 3-4 sessions. That's down about 3.5%. And the hospital chain Max Healthcare is down about 2% or so as well. So this is, broadly the opening that we have in our hands for now. But nothing to complain. 80 points is what we have on the Nifty, 20,900 plus. And, yesterday the mid and small cap part of the market, took a bit of a break, but nothing of that sort today. Mid cap index is up 0.6, and you've got the small cap index. Small cap index is flattish. So, 3 days in a row now, I think the highs are pretty similar for the small cap index. It's not moved up. That's a new kind of, countdown, distance to 21,000, 68 points away. And we were talking about 20,000 a couple of days back, and we're talking about 21,000 now. So that's the extent of the move we've had. Shiv Puri is founder and managing director at TVF Capital, is with us now. Shiv, great to have you with us here. Appreciate your time. Just first of all, characterize, what you're seeing out there. It's kind of hard to, if you're invested, it's kind of hard to do poorly in this market. I mean, the extent of outperformance will vary depending on what you own. You've been a big bull on financials, large cap financials for a while, and it looks like finally their time in the sun is here. Your thoughts, Shiv?
Yeah, I think, thanks for having me first. But, the big fundamental change in the last couple of years has been rising interest rates globally and FII capital into emerging markets, including India, drying up and even going negative. And what we are starting to see is perhaps the first inklings of global inflation somewhat coming under check. In fact, we're seeing really good numbers on the inflationary front. And what that therefore means is that it's possible you have a peaking of interest rates. And you've seen that happen globally in terms of the movements in the 3, 5, and 10-year treasuries. Now, if you have that, you're going to start seeing flows come into risk assets. And that means we could have a year coming into 2024 where you could finally see real meaningful foreign capital come into certain emerging markets, and India being a beneficiary of that. We haven't had that for the last 5 or 6 years. So this could be a bit of a new paradigm, and I think the markets may be getting a little whiff of that. In addition to the fact that we have a national election coming next year, and perhaps the recent state elections have given people some comfort that there would be more stability and continuity on the political front. So I think it's those two big reasons where there is a whiff in the market that might be the case, which is giving it a little bit of a impetus at the moment.
Hi, Shiv. Good morning. Nigel on this side. Do you think that we're running a little ahead of ourselves at 21,000? We're thumping the table and saying it belongs to us the next 10 years, and it could very well be so. The problem is, in the near term, have we run a little too quick?
Well, as an observer of the Indian markets for over 2 decades, it actually fits the norm where, we tend to have sharp movements in the markets followed by a time correction. And this time it would probably be something similar. I don't think we've, in certain sectors, got ahead of ourselves. If we have got ahead of ourselves, it's probably in some of the mid and small cap names. But if you look at what Prashant just mentioned on the large cap financials, I think they're all still quite reasonable. I mean, the largest private sector bank in the country trades at mid-teens times forward earnings, and they're still a pretty good company. So there are opportunities like that that are very reasonably priced, despite the index being at 21,000.
Okay, got it. Shiv, just to kind of dive into financials a little bit more, what are the top ideas there? Is it, or you buy a bunch of them and kind of sit tight? because there are different dynamics at play. I mean, all these stocks have done well at different points in time. HDFC Bank we've discussed quite a bit. Kotak maybe a little lesser so. They've got a new man at the top. 4 years now, the stock's not done very much. What's the sense? What are the top ideas here?
Well, what is happening, I think, in financials is that scale is starting to matter. And we'll see more of that. In the short term, you might have certain small banks and certain small NBFCs that can make inroads either on the deposit side or on the lending side. But they're falling behind on investing in technology. And that is going to matter in the years to come now. So, the real game here, and it's no different elsewhere in the world, is in financials, size plays a huge advantage. It's not that because you're smaller, you can grow faster. That's good in a business that generates cash flow. But financials is a lending business. And so just growing faster doesn't necessarily mean you run a better business. So I think if you look at sort of the top private sector financial firms, without going into any individual name, which I can't, but a couple of them seem to be incredibly well positioned to not only leverage technology, fix the issues that they've had, but also that they're being very aggressive on gathering low-cost deposits. And that, to me, is the most important thing in banking, is to make sure that you have granular, retail, low-cost deposits that you can use to build a great lending institution. So I think they're doing the things right. I mean, we all know that the balance sheet side looks fantastic. I mean, this is the best balance sheet Indian banking has had in the last 2 decades. There's no question about that. So they have a great platform, a great wicket, so to speak. And for those that will execute, and they're only less than a handful, the runway for growth looks pretty long. We've never had a situation where our economy does well and its leading financial institutions don't do well.
No, that's a fair point. Shiv, so that's financials, and that, I mean, when you buy the top financials, you kind of get a play on pretty much everything, right? Because I mean, if the economy does well and various parts does well, they lend everywhere, so you get pieces of everything. But to have a more concentrated bet away from financials, where else are you seeing opportunities? What else do you own? It's been a while since we've spoken, so why don't you update us?
So, one of the very interesting things that I don't think we talk much about is that when an economy goes from 1 trillion to 2 trillion, there are certain areas that people spend in. When it goes from 2 to 3, there are even more dramatic changes. That extra trillion that comes from 2 to 3 is actually very interesting for most companies because it goes into spending in healthcare services, in buying other financial products like insurance. It goes into discretionary spend. A lot of the first 2 trillion has to go into meeting basic needs. So we're now hitting, I think, that sweet spot where a lot of this spend will go into services. We're seeing what's happening with healthcare services, and not just the performance of hospital stocks, but just the requirement for people wanting higher quality healthcare. We're seeing that in there have been regulatory issues in insurance, but as those get overcome, there are certain, and there's been mis-selling, and we all know all of that. But it is a requirement, it is a need that I think will only get bigger. So travel, leisure, consumer discretionary, these are areas that I think benefit quite distinctly as we hit 3 trillion and higher.
All right, Shiv, always a pleasure speaking with you. Wish you a good time in the markets. And wish to speak to you soon as well. But with that, let's move on and let's talk about an interesting conversation that we've lined up for you today. CNBC-TV18 is entering its 25th year tomorrow. This entire week, we've been speaking to a whole host of top managements in India Inc. And today, we're talking about the top of them all when it comes to the beer industry in India, United Breweries. That stock is on our radar. A bunch of things that have happened. We've had a new leader join in, Vivek Gupta, who's the MD and CEO of the company, joined the company in September itself from Udaan after spending nearly 2 decades in P&G before that as well. Vivek, this is your first media interaction. Thank you so much for joining in. Wish you good luck in the company. And, as you join us as we enter our 25th year, it's been 2 months at the helm for you. Your thoughts on what you've learned about the company so far, your vision for United Breweries, say, in the next couple of years, and if you could, quantify that vision in terms of what your aspirations are, volume growth, revenue growth, market share, margins.
Thank you. And first of all, congratulations for 25 years for CNBC. I've been an audience of yours. I think you've asked a lot of questions in the first thing. I'll just start with, it has been exciting 2 months. I would say the beer category is growing mid to high single digit in India. And we continue to expect the category to grow. There's a huge opportunity. The penetration of beer in India, in urban India, is less than 20%. In rural, the penetration is even low because of the accessibility and availability of beer, because number of outlets who sell beer is very low. So we expect, beer to continue to grow in India. The macroeconomic factors are very, very positive. Urbanization, young population, all these are indicators globally and locally as well for the growth of this segment. So I think my goal is to really lead the category growth in India. As you know, United Breweries, we actually are fortunate to at least delight almost 60% of the consumers in this category. And we continue to expand our lead. We continue to grow the category in India. We continue to bring some great innovation. As you know, we are now part of global Heineken team. So we have great domestic brand like Kingfisher, but we also bring our muscle from the world's largest value share brand Heineken in India. And combination of domestic innovation as well as best-in-class global innovations will mean that consumer will get the best quality beer in India and more variety of beer in India in future. So our focus is to really grow category, grow our market share, delight consumer, work with the regulatory to simplify and ease of doing business on beer, to promote moderate alcohol in India, and to build a great team. That's our key priorities.
Cheers to that, Vivek, and thanks so much for joining in here on the show. Nigel on this side, and I'm one of those who analyzes the numbers and also one of your key clients as well, maybe, from the beer market. So I know my beer. But, the worry is that how do you sell the beer? Today it's got way more competitive than, say, 5-6 years back. And that's resulted in United Breweries losing some market share, particularly in the last 2 to 3 years. My question to you is, if you're expecting the industry to grow at a decent clip, can you outgrow the industry? Where do you see your market share headed? And also, I believe in premium beers, that's where the market share has got eroded a little bit more. So what are you doing out there? Where does the market share move in both these two categories?
Hi, Nigel. You definitely know about the beer. First of all, I would say, the competition is very welcome in this category, especially when the penetration is so low. So the more players entering the category, more we are talking about the beer penetration will grow. And I am delighted that, there are companies who are bringing quality products and, we already have a very strong portfolio. I think you're also right that in the last few months or few years, we have not done extremely well on premium. We have more opportunity to do. But having said that, I would say that we are very focused on growing each of the consumer cohorts. For example, there is an opportunity to have an entry-level beer in economy, because in India, still it's a spirits market that 80-85% consumers drink hard liquor, which we know we want to move towards moderation. So there is an opportunity to have an entry-level beer. There's an opportunity to have a more sessionable, or what you're calling it as a premium beer. There's an opportunity to bring more aspirational beer and global brands in India. So I think from our point of view, we are very geared up for that growth. Our premium business is expecting to grow around 40 to 45% next year. We are bringing a series of innovation. We are doing a lot of work in upgrading our technology, upgrading our quality. And I actually think that as the category grows, and also as an industry, I think we also need a voice to ensure that we continue to engage with the government stakeholders so that we can simplify the availability of beer, we can make it more affordable. So I'm pretty confident that the innovation portfolio we have, the knowledge of beer we have,
Vivek,
the strong muscle we have.
Vivek, just to come in here, you've just taken over, so I won't ask you a forward guidance, but at current reckoning, what is your market share in both, beer segment as well as in the premium beer segment. If you could give us an updated number. And as of now, how much of your revenue comes in from premium?
So our overall market share is in the range of 45 to 46 on the total beer category right now. And we, for the last couple of quarters, we are doing pretty well on that. On the premium, we are less than 20% market share right now.
Okay. Vivek, hi. Good morning. So as market share, Prashant here. I think what investors want to know is volume growth. How will you drive volume growth? And what is the guidance from here out? I don't know if you saw Bira, which is one of your competitors. They put out a presentation after their second quarter results. Numbers are, industry growth itself is not looking all that great. During COVID and maybe post-COVID, many categories within the beer segment saw a bump. But I think all of that is kind of tapered off. And add to that all of this new competition, sort of new well-funded players who have come in. So can you tell us what is the volume growth target at United Breweries from here?
See, we are seeing a 5 to 7% category growth right now. We declared our results for the last quarter where we showed about a 7% volume growth. We continue to plan to grow higher than the market. That's our plan. I can't give you the specific numbers, but definitely our guidance is to grow faster than the market. And there is definitely an opportunity for us to expand our portfolio, bring more innovation, and continue to drive the fundamentals of the category. Because as you know, the per liter consumption in India is only 2.2 versus global average of 30. So there is enough, opportunity to increase consumption of beer with the users. There is enough opportunity to grow penetration.
Vivek, would you, sorry, we're not, the idea is not to interrupt, but, we have limited time. Would you aggressively bring global brands from the Heineken global portfolio? I mean, are we going to see a slew of product launches here?
We just recently launched Heineken StoveKraft beer in Mumbai, which is one of the best beer in India. So we continue to bring the best innovation in India.
Right. You did speak about wanting to grow faster than the market. 5 to 7% is what the category is growing at in terms of volumes. Last quarter, you grew 7% in an overall volumes. Premium grew at around 10%. Let's break that down for us as well. How much do you expect the popular volumes to grow by? How much do you expect the premium volumes to grow by? And as a proportion of your sales, how much would premium be as a contributor going forward? What's your target here?
So as I said, our first focus is to really drive category growth and grow overall shares in the market. I think I'm less worried about the mix of premium and the economy. I think having said that, based on our innovation portfolio, we expect premium to grow much faster than the economy and mainstream sector.
So what is your revenue mix right now? How much comes in from premium? How much is from popular? And how much is from, how much do you anticipate coming in from the foreign brands?
So we are right now, our 85% of the volumes come from the mainstream and popular, and around 15% of our revenue comes from premium.
Okay, all right. Vivek, let's talk about margins then. There were two problems for you in the last few months. One is that barley prices had spiked up, which have now declined by close to 30%. So that's good news for you. And the second factor was, input costs like glass and other inputs. Well, they had spiked up, but now I believe they're stabilizing. So where does your gross margin head from here? I was looking at it in the last few quarters. It's come down drastically. From I think 50% plus, it's come to sub 45%. So what kind of improvement can we see? And is the worst of gross margin and EBITDA margin pressure behind you?
I won't say the worst is behind us, but you're absolutely right. We had significant headwinds on barley pricing and barley supplies. We expect this to cool down. We expect this to be more stable. Even on the glass prices, there is an availability challenge, but we're also working with the manufacturers there. So we expect the margins to improve, but we also want to reinvest in the business. As I mentioned, our primary goal is to drive category growth in a very competitive environment. So you definitely see a progression on our gross margin increase, but we are still operating in a very volatile world.
Vivek, sorry, just to come back to that volume question, margins, of course, you will get this tailwind of lower input prices, etc. You said industry growth is 7%. You aim to do at least 10%?
We want to do faster than the industry.
But how much faster? What will you be able to? What do you kind of, you must have set internal goals. If you can give us a broad ballpark idea. What should we expect?
As I again said, I think one of the impact we don't know is about the general elections in 2024.
Exactly.
And we are doing that assessment. So that's why I can't give you an exact number, but our focus is to still grow market share in India next year, which is to grow faster than the category. So we'll understand where election impact comes in the season.
And that actually brings us to an important regulatory question as well. I mean, Telangana was facing supply capacity constraints during the peak season. Volumes in the first quarter, of course, for you were impacted by lower interstate sales as well. All of that anniversarizes in the third quarter. And I believe, the industry itself, the representation went to the government of Maharashtra too, to consider reduction of excise duty on beer. I wanted your thoughts on how you view the regulatory environment in the next 6 months, given the state elections have just happened. There is a central election. In light of that, how does demand pan out?
I would say that we continue to work with various state governments because as you see that state by state, the regulations on industry are different. We continue to work with them and share the opportunity of why we should have a moderation beer. So I think we are seeing very positive engagement with many governments, but it's more work to do. And we continue to advocate for low taxation on beer, more availability of beer. And I don't think it will change dramatically over the next 6 months, but we'll continue to see the progress.
And on your margins itself, you said that while gross margins will grow higher, you will reinvest them back into category growth and growing your market share, etc. So EBITDA margins, how much below will you not go? I mean, the first half of this year is 10%. In the past, you've done around 17, 18% margins as well. So what is the band that you will be comfortable with?
I think our idea is to drive profitable growth. So we'll have a sequential progress on our margins. We will not go with extremes, but we'll continue to show the progress on both gross margins as well as EBITDA.
So a couple of 100 basis points improvement possible from here, say in the next 6 months. By the end of this year, can margins improve by around 200 basis points? You're going to grow faster. Input costs have cooled off. Focus on premiumization. Put all this together, 150, 200 basis points improvement possible by quarter 4?
I think everything is possible, but we have to continue to execute the plan.
But that's your target?
I always work on stretch targets.
All right, we'll do that.
Cheers to that.
Well, Vivek, thank you so much for joining in, giving us your outlook for the business. Unfortunately, my goal here is to just analyze these numbers. Like my colleagues here, I haven't tried the product. I'm a teetotaler here, but cheers to you. And what I can say is that if you're not drinking, then perhaps you're objectively looking at the numbers a little more, reading the labels as well.
Vivek, I'm looking at the numbers.
And you can 0-0.
We will talk about that later because it doesn't particularly taste very good, does it?
I think it needs a longer conversation.
Yes.
I
don't know, Vivek, at 9:30 a.m. if I can relate to Mangalam about how good it tastes, but that for another day. Thanks so much for joining in. Appreciate you giving us your inputs and your outlook as well with regard to the company. For the time being, though, we'll slip into a short break. Kishore Patel, the co-founder, MD and CEO at KPIT Technologies, will be joining in to give us the business outlook going forward. And later on, we'll be connecting with Mr. Nilesh Kambli, the Chief Financial Officer at Star Health and Allied Business on the other side. Stay with us.
Co-presented by...
Well, the markets have come off a little bit from the top, and that's because the Nifty Bank, after a very, very strong run, has seen some profit taking from the top. I think it's par for the course, though. We're down close to 200 points from the day's high on the Nifty Bank, but I think still the trend is on the upward direction. It's pausing for breath in today's trading session. But it's CNBC-TV18's 25th birthday week. And this week, we'll be speaking to a whole host of top managements in India. Let's talk about KPIT Technologies. It's been a rank outperformer this year. Big gains is what we're seeing on that one. Year to date, the chart should come up for you. And there are a couple of things that we want to talk about. Now, according to a Kotak Institutional Equities report, insourcing by one of its key clients, Packer, is a risk for KPIT Technologies. Mr. Kishore Patel, the co-founder, MD and CEO of KPIT Technologies, joins us on the show. Hi, Mr. Patel. Good morning. Thanks so much for joining in. Well, tell us, what do you have to comment on this? Is insourcing by Packer a risk to your business? How do you see things playing out?
Yeah, before I start, congratulations on your anniversary. I've been talking to the channel for 20 years, so it's my pleasure to be here.
Thank you, sir, for being part of our journey, sir, and joining in on the channel as well and giving us insights.
So coming to your point, I think these news items comes in bits and pieces, and a lot of people interpret it differently. I remember the first thing is any large client will have couple of large partners, if I have to say, and they will basically carve out places for them who can really significantly add value to them. So for example, we are into like a software-defined vehicle, the big part of us, new architecture, middleware, operating system. There are other parts where somebody else can come in. So that is one point. The second point is not everything is outsourced naturally. Actually, many OEMs want to have 30 to 50% of their part themselves, right? Some 30, some 50. No, it is not very easy for them to do it because software has not been their core area of expertise. So many companies approach different parts. Like, for example, in case here, this was our understanding when we started 10 years back. It's not now, it's like 10 years, our assignment. And they took 10 years and then think they can build in some areas. And that's where some part is done. Actually, our business is not gone down in the sense it's growing. The point I wanted to bring out is there are many different models you will see also in the market. I mean, I know that there are, so for example, if a OEM has to set up, say, 1/3 of their capacity themselves, there are different models. They will come by themselves, they'll do BOT. Now, I know that some of the OEMs are also looking for setting up a joint venture with a local partner, and then they will buy it out. Those kind of models will be coming.
No, Mr. Patil,
just away from that, the point I wanted to say, I just wanted to say that we are focused on the other parts which we are talked about. So that is not going to change anything what we have said.
Mr. Patil, but has the risk increased? Is the point at the margin?
No. It won't increase. What I'm trying to say is if there is a if somebody is spending $100, I'm just saying, and 1/3 he wants to spend, 1/3 and or 30 or 50 they want to do themselves, and 50 they want to outsource. Our goal and our business model is to maximize on that 50 to being a strategic part.
No, is that 30 becoming more? Is the question? I mean, are a lot of OEMs say?
No, it is. It is not. It is not.
Okay.
So, simple answer to your question is it can be 30 or it can be 50. It is not going to be 100.
All right. Okay, so you will still have some business. It is not going to be 100. Let's ask about that 100 itself. How is the spend environment right now? Because I'm looking at GM, Ford, all of them having indicated that they're dialing down investments in electric vehicles, and a bunch of people have pulled down or scaled back their spend. So is there a risk for that 100 to shrink to, say, 95 or 90? Just wanted your thoughts on how the spends environment in total is.
So I will give you some trends and then we will talk about specific. On the trend side, if you really look at all the reports you look at, there are multiple, McKinsey, BCG, there are multiple reports in the market. They talk about 8 to 10 years of very strong increase in the spend by 9% every year. So overall spend of 100 will grow by 9%. And there are areas which are not part of it. Now, what happens is if there is a business environment where people have to cut down the costs, there are two parts of the expenses they incur. The new technology area, which KPIT focuses on, is roughly about 30-40%. 60% is the legacy part. And that legacy part will go down every year, and this part, new technology part, will keep on growing. So in the short term, if they have to cut, largely it is cut through the conventional spend areas.
So basically, this means that there is, no big risk that you foresee to your growth prospects here because of the macros. Is that correct?
No, nothing has changed than we have said.
So does that mean that you maintain your guidance at around 37% FY24 constant currency growth, or is there any upside to that?
We'll see that. But 37% is what we have said, and we have said profitability 20%. All the that, which is a very strong guidance you would imagine. So I think we are confident about it.
Okay. Got that. But by the way, we have one more listed entity, Mr. Patil. Tata Technologies came to the market. So, and of course, it's got a very strong reception because the space that you're in, and of course, you've been the poster boy in that sense. Just a quick, the same Kotak note also talks about how large OEMs in the US and what they are talking about in terms of spending on EV R&D, I mean, new EV products, etc. Because the category penetration over the last couple of months is kind of stagnant, it's not going up sharply, they've slowed down investments. Is that showing up anywhere on your radar or not really?
Nothing substantial. See, some clients a little bit here, and I have enough clients who are accelerated. So it is nothing specifically. I may say at a high level, US has not they have been a little softer as compared to look at Asia, where they are increasing the spend, and even Europe also looks okay.
Okay. All right, Mr. Patil, very quickly, you have a good amount of cash, right, in your books. Should we hear about some inorganic growth, say, before the end of this fiscal? Because sometimes when things slow down, other companies, maybe their balance sheet doesn't support. And it gives you all an opportunity to go ahead and grow inorganically. Are you looking at a couple of targets?
No, I think we are looking at strong organic growth. I think we continue to look at organic growth stronger.
So no inorganic growth for now?
I mean, nothing in the sight, nothing significant.
All right, Mr. Patil, thank you so much for joining in, not just today, for the last 20 years, as you've reminded us once again, for being a long-term partner of our channel. Wish you good luck for your business, and we hope and pray that this association continues for the next 20 years as well.
All right. Well, that's KPIT. Stock's done phenomenally well. Let's just take a quick second to look at the market as well. 90 points higher, 20,941 is where the Nifty is at. Adani stocks are still higher, but I mean, there has been some give back. I mean, Adani Green was at one point almost up another 20 today. It's come off a little bit. It's up 13. We've got Adani Wilmar, which is up 4. Transmission is up about 8.5%. And Ports, which was up about, I think, about 3-4%, is up about 1%. So naturally, after the last 2 days of very strong gains, I think there is, things are a little soft. Not soft, actually, they're not as strong, let me put it that way. Angel One is a stock which was not in the mix in the morning. It's up 5.5%. These capital market plays, of course, have done well. JK Paper was a big mover yesterday. It's following through with some gains. JSW Infra, which is the second largest private ports company, that's up another 3% or so. So REC is another one. PFC REC, of course, have done very well. REC comes up with about a 3% pop right now. So it's a good-looking screen once again. Well, as we mentioned earlier, this is CNBC-TV18's sort of 24th birthday. We're entering the 25th year. And this entire week, we've been speaking with a whole host of top companies in India Inc. Let's now focus on someone from the insurance space. Health insurance is what I'm talking about. Star Health is one of the top companies there. We have the Chief Financial Officer, Mr. Nilesh Kamble, who's joining in to discuss the business momentum. Nilesh, good morning. Great to have you with us here in this special week with us here on CNBC-TV18. Just a quick sense on things, Nilesh, from the last time we spoke. How are things kind of panning out? What's been growth like in the third quarter so far? Just give us a business update so far.
Yeah, thank you for having me on the show, and congratulations on your 25th year. So in terms of growth, the industry is growing at around 18% when it comes to retail health business, and Star is going in line with the industry growth and maintaining its market share of 33%. Overall, health insurance industry is growing at 22%, driven by group health and government health business. And in the group health segment, we are growing at 25%.
Sorry, group health is growing at 25%, and overall business? This is quarter to date
overall
numbers,
business,
is it?
Yeah, overall also we are growing at around 18%.
Growing at around 18%. Just wanted to kind of turn your attention to something we spoke about, a couple of interactions back, but I think it's once again come back into the radar. Some disputes with hospitals, etc., Nilesh, especially in the Ahmedabad region. I remember last time we spoke, you said that is largely behind you. It's an issue which has been resolved. Is that so, or I mean, is it still kind of at the margin a bit of a worry with many hospitals opting out of the network?
Not really. I mean, the issue is resolved. We continue to work in Ahmedabad. All our cashless facilities are enabled. We have reached certain consensus in terms of, before delisting or deep empanelment of hospitals, we will intimate the association. So it's a very nice relationship that we continue to have with the Ahmedabad hospitals. No worries as such.
All right. Hi, good morning, sir. Thanks so much for joining in. Non-agency channels, they contribute close to around 32% of the fresh business, I think, in the first half of the year. By the end of this year, where does it go? And also part of this non-agency business is bancassurance. How is that contributing and where is that headed?
Yeah, so digital and bank insurance businesses are doing really well for us. They continue to grow at close to 50% when it comes to new business. And this momentum will continue in the second half as well. We have added some new partners in the bank insurance channel. AU Small Finance Bank, Bank of Maharashtra, Standard Chartered Bank will continue, will start the business. And we see a good momentum going into quarter 4 for these channels.
All right. And what about, your claims ratio in quarter 3? There was obviously seasonal spike because of the second quarter. How have the claims ratio trended in the third quarter so far? And what do you end this year with when it comes to the combined ratio?
We saw some heightened impact of fever and infectious diseases, which continued in October. As we speak, the loss ratio or the claims ratio has stabilized. We hope it continues in December as well. In terms of full year, we don't want to give any guidance per se. We continue to work on controlling and improving on our claims ratio.
We're at the end of the year, Nilesh. I remember you'd taken a big price increase. It was earlier this year, I think. Are there any other plans for price increases?
Yeah, we are looking at certain price increases in our 2 products which have reached the threshold limits. It will be in the range of around 15 to 20% price increase that we're planning to take.
15 to 20%. And what does that do to your overall demand then? Because, you've trailed the industry. Industry grew around 27%. Some of the peers in October, you grew around 22% Going forward, what do you, expect in terms of growth versus the industry? Would you grow faster? What are you doing?
See, basically what we have done is we have tightened certain underwriting guidelines. The growth of 18% that we are having is by design, by choice, and it's not by chance. We have slowed down business in certain loss-making categories like portability and loss-making locations. We are working with the strategy of long-term profitability of the business. We don't want to underwriting businesses which will not give us profits. So we are very happy with the kind of growth that we are doing in. We continue to maintain our market share. So, and the other channels like digital bank are doing well for us.
Yeah, you said digital and bank insurance, I think, are growing at the fastest clip. So how much do they contribute as of now? I missed that number. I recall you said it's growing at a very fast clip, I think, at more than 50%. So what does it contribute currently?
So currently, both together contribute around 11 to 12% of our overall business. Bank
and do you want to split that for us? The 11%, how is it split between both these two? And where is this 11% headed?
So bank assurance is around 4 to 5%, and the balance is digital business. It's a function of the new business, with new business contributing around 30 to 35%. Over a period of time, that will be the overall mix.
The last price increase in Family Health Optima, that was a 25% increase, right? This one is for what part of the portfolio? I mean, if you can give us a sense. This 15 to 20 that you will take, and has approval from IRDA come through? Do you need approval?
So, that's the best thing. We don't need any approval. IRDA has given flexibility in terms of product pricing. The current portfolio that we're talking about is in the range of around 13 to 15%, where we'll be taking this price increase.
13 to 15% of the portfolio will see a 15 to 20% price increase, right? And this will play out over what sort of period of time as policies come up for renewal? By when will we see the impact play through?
Yeah, so this will become applicable for new policies starting this month or next month. And after 3 months, it becomes applicable for the renewable portfolio. So, you see it playing out over a 12 to 15 months period.
All right. Thank you so much for joining in, Nilesh. Wish you good luck and hope to see better growth in the second half of this year as you planned as well. With that, let's bring focus back on the markets actually. Now, the Nifty is holding up with 80 points, and this despite a cut of almost 110 points on the Nifty Bank. The biggest reason for that is the contribution coming in from the IT stocks and Reliance. So the Nifty IT index should come up for you. That's moved higher, and that's about 1.5%, the largest sectoral gainer in today's trading session so far. The other one is Reliance. That's the top contributor in terms of overall gains coming in. And we have ITC also, which has woken up. So the last couple of days belong to the Nifty Bank. Everyone's eyeing that 50,000 mark on the Nifty Bank. But not to forget that the other heavyweights like Reliance, ITC, all the IT stocks, they've been underperforming. So the question is, will they come back as well? And if they do, with the Nifty Bank's momentum, perhaps the Nifty may move higher. So that's the setup as of now, Nigel.
Well, yeah, Mangalam, just one more thing. JTL Industries, there's a very large trade that's taken out there. I'm trying to find out further information in terms of this. But there's a very, very huge trade. It came out as one of the top, volume buzzers today. So JTL Industries actually is down close to around 6.5%. And we'll try to get you more in terms of who were part of that block trade. But volumes very, very high for the first hour of trade. Well, Mitesh Thakkar is back with us. Mitesh, give us your view on the start today. The Nifty Bank, it's lower by 100 points, but is it providing an entry opportunity, as well as fill us in with a couple of picks?
So, I think the Nifty Bank I would want to buy, but maybe a bit more lower. So, greedy in that sense, I think 46,750, 46,700 is my preferred buying zone for the Bank Nifty. And once you're buying over there, keep a stop below 46,500, and I think we should retest the highs of 47,250 and maybe even cross that. So stay positive. I think in the Bank Nifty, another 100 points lower, I would want to buy. The other part, on the stock side, after a long time, I have one sell call and one buy call. So on the selling side is Bajaj Auto. I think today is starting some, signals of, is giving some signals of starting a correction. So Bajaj Auto is a sell. Keep a stop just above levels of 6,090 and look for a target of 5,900. And on the buying side is Bata India, which I would recommend buying with a stop below 1636 and a target of 1685 is what I would recommend.
Okay, all right. Bata, maybe buy the slightly lower. Bajaj is a sell, and Bank Nifty you'd buy maybe a little lower. Bank Nifty is turned around a little bit, is down about 1/3% or so. Thanks very much, Mitesh, for joining us. Actually the market breadth, overall market breadth, like yesterday, actually there were more losers as compared to gainers. Even on Monday, when we had that massive 400-point move, market breadth was, it was strong, but there were enough and more names which actually were down, large liquid names which were lower. And that is the reason why when many people say, well, the market's up so much, but my portfolio is not moving in a similar kind of fashion. It depends, of course, on what you own. But the characteristic of the last 3 days has been that even though the indices, large cap indices have done phenomenally well, in the broader market, it's not just been completely one way. There have been lots of names which are lower as well. And today also is the case. Just 150 stocks separate losers and gainers, in the broader sense. Just a few names there actually on the downside, because we've been highlighting everything on the upside. CAMS is down 4%. You should have that up, 2750 or so on CAMS. Canfin Homes is down sharply, 4% or so. IREDA will come up, that's down about 1.5%. And there's Suzlon and Balrampur Chini, which are down 3% apiece as well. We'll highlight more stuff. We'll take a quick break here. Manisha is going to be joining us with what's happening in the commodity space. Stay tuned.